Hello, and welcome back to the continuing lecture in ROI and macroeconomics. This is Dr. Jeff Holm, and this is the video number 10, I believe, in this series. In our last video, we talked about the different types of risks that are involved in basically lending, right? In investing. Now, I said this is specifically, these are the risks that are involved with lending. In other words, with bond, right? With bonds. Actually, the reason I said that is because in case of stocks, the risks would be slightly different. And there's more, but in terms of the broad components, they are not that different. But basically, the risks, because of the risks, you have to add risk premium to that, risk premium, right? And there were 4 risks specifically. One is, inflation risk, right? And I said inflation risk first because inflation is systemic. In other words, it's coming from the macroeconomic system. So it is not user or borrower specific. It affects everyone universally, right? Whereas, and there is, nothing you can do, right, to prevent inflation. As an individual lender, there is nothing you can do to prevent the inflation. The best thing you can do is build in the inflation premium, right? And then the second risk is the default risk. And default risk from here, from the second to the fourth, they are all borrower specific, right? Liquidity risk, maturity risk, default risk, they are all borrower specific. So eventually and finally, we can set up a model for cost of capital, right? Cost of capital, which reflects all the risks involved in lending. And the cost involved in borrowing, right? Think about it. If you're a borrower, right, basically you have to pay pure return, and you have to pay the inflation premium and default risk premium and liquidity risk premium and maturity risk premium, right? So that is the cost of capital. Now, this is basically a theoretical breakdown, and although in reality it is, in reality, yes, it's also, cost of capital is cost of capital consists of these components. But what I'm saying is that in reality, it's very difficult to split it into these different components. Inflation risk and default risk, they are relatively, not that difficult to tell. How much of the cost of capital is due to inflation? 2 to 4%, right? And how much of it is, default risk? Depending on the credit rating or risk level of the borrower, default risk can range anywhere between 2 to 8%, right? But that's conventionally how it is. and then how much of that is liquid, and then out of the actual rate, actual borrowing rate, right? Borrowers borrowing rate. It's hard to tell how much of that if is liquidity risk and maturity risk. I mean, maturity risk is probably easy to tell because the difference between the if after accounting for all pure return, inflation, default risk, and then whatever uh, it remains, and uh, the difference between, and if this is a long term, uh, like 10-year loan or 10-year bond, and the difference between the short term bond return and whatever is remaining is the maturity risk premium. Although theoretically we can construct it that way, but as I said, in reality, it's really a hair splitting thing. So it's not easy to. But now, so we are moving on to yield curve. Okay, so whatever these slides, actually we have discussed it uh, in the previous videos, right? Treasury bill, treasury note, treasury bond, and treasury bill risk-free rate, very short-term federal securities, treasury bills, uh, pay risk-free rate. Okay. So that's and then yield curve is directly related to the maturity risk. Now, remember, maturity risk is due to the different maturities, right, of the bond. The longer term bonds have more uncertainty um, because of more uncertainty, the risk premium will have to be higher. In other words, all the annualized returns between short-term bond and long-term bond, all annual return. I've been telling you, when we say interest rate, they all mean annualized interest rates. So 10-year bond, the annualized the interest rate on 10-year bond must be greater than 1-year bond. Um, Otherwise, to compensate for the more uncertainty associated with the longer term. So if we plot the returns on these returns from short term to long term, right, you will see a curve sloping upward like this. This blue curve, right, represents the plots of the returns from short term to long term, and it's quite logical and easily understood why the long term bonds have higher returns, right? Yield, once again, yield is another name for return. But yield is not exactly the interest rate. Yield is more than interest rate, actually. Why? Remember the scenario 1 and scenario 2, right? In scenario 2, you have two sources of cash flow. One is capital gains, the other one is rental income. Now, apply that concept to the bond, right? I told you coupon bond is like the scenario 2, and zero coupon bond is like scenario one, right? And in coupon bond, so the return includes both interest is like the rent, right? Um, the and the bond price will be eventually bond price will become eventually uh, the face value, right? And some bonds are premium bonds, right? Some coupon bonds are premium bonds. Some um, coupon bonds are discount bonds. So depending on whether it is premium bond or uh, discount bond, eventually there will be capital gains or capital loss. So your return will include, right? Your annualized return will have to reflect both uh, interest and uh, capital gains or capital loss. So that's the yield. That's the return, right? So yield is another name for annualized return. So it's not simply interest rate. Um, Anyway, but if it is a zero coupon, right, there will only be capital gains. Um, so think about it. The return on the short-term bonds will have to be lower, and return on the long-term bond will have to be higher, significantly higher, right? Um, so that is, if you plot, if you connect those plots, then it will form a curve like this. It will form a curve. So this is the normal case, right? In the normal economy, right, short-term yields are lower than long-term yields, and the yield curve will show the yield curve will be upward sloping, right? But sometimes you see an inverted yield curve. This is crazy, don't you think? How can inverted yield curve means, a short-term return is higher than the long-term return, and how can that be? How can it happen? How can it ever happen, right? So this is, something weird about the inverted yield curve. But when does this happen? When does this happen? Well, it happens uh, uh, when the market expects or anticipates recession anytime soon. In other words, impending recession. This is um, so the market is inverted yield curve is the a sign of impending recession. And impending means what? Within the short run. And what does the short run mean? Within under 1 year, right? Why? I've been telling you, forecasting is forecasting becomes pretty much an art when I mean, forecasting is a science when the horizon, forecasting horizon is relatively short. Within a lot of factors, factors that determine, the course of the interest rate or anything that's to be forecasted. Um, any Everything is, all the factors are relatively clear and well known within 1 year, within the short run. But once the forecasting horizon moves into a long term, like 5 years, 10 years, forecasting becomes uh, uh, inaccurate, right? Uh, so uh, if when I say the market anticipates a recession, then it is a recession that is within the forecasting horizon, right? Once again, it's hard to forecast recession in beyond 5 years, in 5 years, or in 10 years, or uh, 30 years. I mean, first of all, even if it is even if you can forecast it like that for such a long horizon, what's going to happen? I mean, if you can forecast, there are a lot of things that are in flux, right? A lot of things are the situation is fluid. Whatever happens within 1 year, I mean, we can prepare for that. But until, like, I mean, does it help? The recession that might happen in 5 years, does it? Um, a lot of things can happen before then. It may not. It may not happen in 5 years, right? If you know already, what's gonna, if there's gonna be recession in 5 years, we can already prepare. The economists, the government, the Federal Reserve, they can all prepare, right, for that and avert the recession in 5 years, right? That might happen in 5 years, right? So there won't be actually uh, we can prevent recession, right, already before it starts. But what we cannot do, right? I mean, recession impending within, like 6 months. There isn't much the Federal Reserve. I mean, the Federal Reserve will do something, but the economy, macroeconomy, is like a big steamship, right? Like Titanic. You see, and when you spot the iceberg, right? Suddenly, in 1,000 yards ahead, of course, you will. The captain will turn the helm or wheel, uh, to avoid contact with the iceberg. But the ship will if you cannot make an abrupt turn with a big steamship, because if you make a like a 90-degree turn, suddenly the ship will capsize, right? Um, Also, the so big ships can make a very slow turn. The turn will have curvature. So if you make a turn now, right, it will be too late to avoid hitting that iceberg, right? So anyway, Federal Reserve cannot, prevent and avert a recession, uh, that is uh, uh, happening so suddenly, right? Or that is happening within like such a short run. They will do whatever they can to soften to lessen the impact of the contact, but it's not going to be that easy. Anyway, why? Then the question is why? Why is it uh, why does it show the inverted yield curve when um, recession is impending? Well, the reason is it's because of this. Now, think about it. If you, what are you gonna do if the return on the short term, if the return on the short term bond is going up? Uh, why is it? Why? What does that mean? What if the return goes up? What happens to the price? What is happening to the price? Hmm? So far, if you happen to, following my lecture um, faithfully, you would understand. there is an inverse relationship between the price and the return. Isn't that right? There's an inverse relationship. What does that? So if the return goes up, that means prices. What does that mean? Price is going down or going? Price is going down. Why is the price of the short-term bond going down? Huh? That means people are not buying short-term bond, right? Not just that. I mean, the only reason the price is going down is because there is more supply than demand. Make sense? Why more supply than demand? Because people who are already in the short-term bond, not only they are not buying short-term bond, but people who are already in the short-term bonds are dumping the short-term bonds. They are selling off short-term bonds. Why? To get out of the short-term bonds, right? To get out of the short-term bonds. And what do? And why is the return on the long-term bond going down? That means demand for long-term bond is going up. And why? You might wonder. There's going to be a recession within 1 year, within less than 1 year. Why are they getting out of short-term bond and going into the long-term bond? And to you, most of you, short-term bonds are relatively. There is nothing uncertain about short-term bonds, so short-term bond is more less risky than long-term bond. But why are they getting out of? Look, think about it. Short-term bond is less risky when there is no recession. But if there is recession within 1 year and you have short-term bond, that means they are maturing within 1 year. So suppose the recession will hit in 6 months, and your bond matures in 6 months. What are the chances that the companies that sold the short-term bonds, right? The companies of the bonds that you're holding, what if they are? What are the chances that they will sail smoothly without suffering from the recession? During the recession, what's the first thing? Businesses fail. Why? Because people lose jobs. They don't spend, and it's hard to borrow money from the banks or borrow from the bond market because every company is vulnerable to the recession. And when it is time to pay the money, right? When it's time to pay the money, right? They have to cough up, right? If company X is their bond is becoming due in 6 months, and company X has sold, $10 billion worth of bonds. And in 6 months, they have to cough up 10 billion. They have to cough up 10 billion. How likely is it that they can come up with 10 billion to pay the bondholders, especially during the recession? Chances are very low, right? They will come up with that 10 billion and they might default. The chances are high that they might default, right? So that's why they are getting out of the short-term bond. As they are getting out, they are dumping the short-term bonds, meaning there's a large-scale sell-off. With a large-scale sell-off, the price soars. And the difference between the gap between the bond discount, right? The gap between the face value, the selling price, the gap closes. So, the gap widens as they sell off. The price drops. Right? Not price soars. I just say, because time is running out. I'm just saying anything. Okay, we have 5 more minutes. I have to close this up. So as they sell off, the price drop. and as the price drops, the gap between uh, the bond discount or the capital gains, the gap between the face value and the selling price widens. That's why the return goes up. And then when they sell, they get their money back, right? If they sell, and then uh, they want to where they want, then they do what? They move their money into the long-term bond. They move their money into the long-term bond. You might wonder, why don't they hold on to their? Yes, they can hold on to their cash, but cash doesn't earn anything, right? They can put it in the checking account, but checking account is just holding cash, and checking account doesn't pay anything. So what do? They move that money into the long-term bond, uh, and already on top of the demand for long-term bond. And why do they put the money into the long-term bond then? Because long-term bond doesn't mature within 1 year. Long-term bonds will mature in 10 years, 5 years, 2 years. So uh, these companies that sold long-term bonds can weather out. They can weather the recession. They can weather through the recession, right? Why? They don't have to cough up the principal. They don't have to cough up until the bond matures, right? And in the meantime, they only need to pay interest. Paying interest is not a big deal compared to coughing up $10 billion. Paying interest, if you sold $10 billion worth of bonds, and the interest is 5% a year, then still 5% of 10 billion is 500 million. That's not easy either. But you sold compared to coughing up 10 billion, right? Annually paying 500 million, 5%. They can weather through they can weather out the recession, right? And after the recession, uh, the investors weather out. After the recession, they can, and if the economy is normalized, they can pull out of the uh, uh, long-term bond. So the long-term bond return will go back up again, and they put it back into short-term bond. So the short-term bond return will go down again. Okay, so so this is the mechanism, right? Think about it. This is something. Um, this is all very logical process, isn't it right? I mean, um, explaining this phenomenon is logical process. I mean, everything, and the logic is very straightforward and easy. In other words, we haven't used any sophisticated uh, reasoning. It's simply, uh, inverse relationship between the price and return, right? And we add, a time dimension to that, so the maturity, right? And if you can explain it like this, why inverted yield curve is the sign of the impending recession. And I want to show you, I mean, we are running out of time, but let me show you, if possible. I have in our folder, there's a graph of Fed funds rate versus 1 month Treasury bill versus 10-year Treasury note. And in our folder, right? Why isn't it opening? Oh, okay. It is a clear evidence, and a very recent one, uh, of that yield curve, inverted yield curve. Let me, okay, did I stop sharing? Okay, then, where's this thing? Okay. All right. So do you see this now? So I have three, you see the three columns, Fed funds rate, column B. This is 1 month Treasury, column C, and Treasury bill. D, column D, GS10, that's, 10-year Treasury note. And uh, between the time frame is January 2015 through January 2020. So monthly data, monthly data, and I've tracked these three interest rates, and this was before January, so before the pandemic. So the economy was on a normal pattern, and um, you see the blue line is 1 month Treasury. Um, a red line is Fed funds rate. So you can tell the red and the blue curves are moving pretty much in tandem, right? And then this olive green line is the 10-year Treasury note, yield on 10-year Treasury note. Well, they are all returns. Look, the Fed funds rate and 1 month Treasury bill were like near 0%, and starting from January 2016, they are getting close to 0.5, and they were as high as like 2.25% by uh, July 2019, but dropped again somewhere around June 2020. So long-term yields were all higher. Long-term yields were all higher than short-term yields until when? Until like uh, July of 2019, and then they made a cross. The intersection happened, right? They made a cross. So between like June, this would be May or June of 2019 until early January, like end of December 2019. And there was some scare about recession, and during that period, uh, long-term yields were lower than short-term yields, right? You see that? So that is inverted yield curve. I mean, this is not the yield curve. I mean, if you put the um, actually yield curve is, I mean, this is yield curve, but what I'm saying is um, uh, what I'm saying is there is another way to represent yield curve. The difference between the 10-year and 3 months. I didn't use any difference. Uh, uh, And then this is clearly, the inverted yield curve. And then January back to January 2020, and this was before the, pandemic induced recession. They had no idea. It only, started in March, so economy was, showing yield curve was showing normal pattern. But this is the evidence of the yield curve. Uh, uh, Fortunately, though, the reason the yield curve went back to normal was uh, because the recession fear, right? The recession fear was gone, right? By the end of December 2019. So there was about briefly about 6 months period, six to uh, when there was a recession scare, and the inverted yield curve happened. Okay, all right. So that's it for today, and this wraps up actually everything about the first topic. Right. So then uh, I will see you in the next video with the new topic. Okay. All right, end of video.